Welcome to our channel. In this video, I talked in detail about the main reasons that lead companies to increase their prices. One such reason is demand pull inflation, which occurs when there is a high demand for goods and services in the market. This creates a situation where businesses can charge more for their products because people are willing to pay more to get them. Additionally, I touched upon the concept of investments that can outperform inflation. These are investment strategies that aim to provide returns higher than the inflation rate, thereby helping investors maintain or even grow the purchasing power of their money despite the rising cost of goods and services. Companies are raising the prices of their products for a variety of reasons that affect both the market environment and their own strategies. Let's look into the main factors causing this trend. The markup on products has been on the rise. Markups are the difference between what a product cost to make and what it's sold for. Studies have shown that between 2006 and 2019, these have gone up by about 25%. Although the cost of production has actually gone down, companies are keeping this extra money instead of lowering prices for customers. This helps them to increase prices without losing any of their customers. There is a high demand from consumers. Businesses have noticed that people are more than happy to pay higher prices for things they really want or need. This has become even more obvious after the pandemic, as customers are now more willing to accept costlier goods and services for essential items or those they value highly. There have been big disruptions in the supply chain. The COVID-19 pandemic really showed us how fragile global supply chains can be. Because of this, the cost of making and moving products has gone up. To cover this cost, companies are passing them on to the consumers, which means we pay more for what we buy. This is especially a problem when there are not enough workers or when there are difficulties in transportations. There's something called cost push inflation. This happens when the prices of the basic things needed to make products like raw materials, labor, and energy go up. When this cost increase, businesses might pass on the extra expense to the consumers by raising their prices. This is common in industries where cost can change a lot due to things like political events or natural disasters. Companies might raise prices because they think inflation will happen in the future. If they expect that the value of money will go down, they might increase prices now to make sure they don't lose money later. This can lead to a cycle where everyone thinks prices will keep going up, so they start to increase them even more. In markets with not much competition or where a small number of firms are in control, these businesses can easily charge higher prices. This is because people don't have many other choices to buy from. If they raise the price a bit, most customers will still buy because they don't have many other options. The way people think about prices is also important. If they are used to prices going up all the time, they start to accept it. This can lead to a situation where companies feel that they can keep increasing prices because they believe customers will continue to pay. Now let's talk about how much consumers care about price when they are deciding what to buy. This is a big part of how companies decide what to charge for their products. To know how much people will buy if the price changes, companies look at something called price elasticity of demand. If demand doesn't change much even when the price goes up, it's not very sensitive to price changes. But if a small price increase makes people buy a lot less, then demand is very sensitive to price changes. By studying price sensitivity, businesses can divide their customers into groups based on how much they care about price. This helps them make different pricing plans for each group. For example, some might pay more for the same product because they don't mind higher prices, while others might get a better deal if they are very sensitive to price changes. When a company knows how much people care about price, it can decide where it wants to stand among its competitors. If it knows that its customers are less sensitive to price, it can charge a bit more and still keep them. But if people are very sensitive, the company might need to keep prices low to attract more buyers. By understanding price sensitivity, a business can guess how much people will buy at different prices. This helps them set the price just right to get the most money without losing too many customers. It's like walking a tight rope between giving people what they want and making enough profit. In short, knowing how much people care about price helps companies make better decisions about what to charge. They look at the market conditions, their competition, and what customers are willing to pay to find the sweet spot that makes everyone happy and keeps the business running smoothly. Setting prices that align with customer expectations and perceived value is essential for building brand trust and loyalty. Businesses that manage price sensitivity skillfully can strengthen their brand and enhance their position in the market over time. Gaining insights into what consumers are willing to pay for certain features or qualities helps guide product development. By knowing what aspects of a product are most valued by customers, companies can invest in improvements that justify higher prices or create products that cater to budget-conscious buyers. Grasping consumer price sensitivity is vital for setting the right pricing strategies. It aids businesses in optimizing prices, segmenting the market effectively, positioning their brand competitively, and making informed decisions about product enhancements. These insights are important for maximizing revenue and maintaining a competitive edge in the current market. Demand pull inflation is a scenario where the demand for goods and services grows faster than their supply, causing prices to rise. This type of inflation occurs when the economy is robust and consumers have more income to spend, leading to increased demand that businesses struggle to meet with their existing supply. Both demand pull and cost push inflation stem from imbalances in the supply and demand equation. However, while demand pull inflation is driven by high demand, cost push inflation is triggered by supply constraints. Several factors contribute to demand pull inflation, such as low unemployment and high income levels encourage increasing spending, which boost aggregate demand. Strong demand can lead to shortages of raw materials, labor, and other necessary resources. The RBI may print more money during economic crisis, fueling higher demand for goods and services that outpaces supply. If people anticipate future pricing hikes, they may purchase more goods now, causing a supply shortage. Stimulus packages and tax incentives can influence consumer spending patterns and affect the demand for specific products. Overall, understanding price sensitivity and demand pull inflation allows businesses to make well-informed decisions regarding pricing strategies and product development, which are important for success in any market. Demand pull inflation is a situation where the overall price level in an economy rises due to increased demand for goods and services, which outpaces the available supply. This can occur during periods of economic growth or when there is an unexpected surge in demand. We can look at two significant examples of demand pull inflation: the Great Recession and the COVID-19 pandemic. The Great Recession, which took place from 2007 to 2009, was partly caused by a burst in the real estate bubble in the United States. One of the main reasons for this bubble was the growing popularity of mortgage-backed securities. Before the crisis, there was a substantial increase in the creation of MBS by financial institutions. This led to a high demand for these securities among investors, which in turn pushed up housing prices to very high, unstable levels. When the real estate market collapsed, it resulted in a severe economic downturn. The outbreak of the COVID-19 pandemic saw another form of demand pull inflation, which people staying home for extended periods due to lockdowns. There was a sudden increase in the demand for certain products such as hand sanitizers and surgical masks. The supply of these items could not meet the new higher demand, which led to price hikes. People started buying these products in large quantities, creating a shortage and causing further inflation. As the pandemic's impact lessened and people started moving around more freely, there was a rise in the demand for goods like gasoline. Additionally, the war in Ukraine and ongoing supply chain disruptions affected the gasoline supply, pushing prices upwards. Similarly, when people began to travel again, the demand for airline tickets and hotel rooms grew substantially. However, because of staffing shortages, the supply of these services could not immediately match the demand, leading to an increase in their prices. In India, there are two key measures used to track inflation: the Consumer Price Index (CPI) and the Wholesale Price Index (WPI). The CPI looks at the prices that consumers pay for various goods and services, taking into account 8 major categories such as food and drink, clothing, transport, education, medical care, and other goods and services. It's a measure of the cost of living and is calculated based on a basket of goods that includes 697 different items. The WPI, on the other hand, focuses on the prices at the wholesale level. It is calculated by the Ministry of Commerce and Industry and includes a basket of goods consisting of manufactured products 65%, primary articles like food 20.1%, and fuel and power 14.9%. It does not consider services. The RBI is responsible for monitoring the Indian economy and ensuring that inflation remains stable. It uses the CPI as a guide to predict inflation rates. For the financial year 2022-23, the projected CPI inflation rate is 6.7%. To manage the economy, the RBI employs various strategies such as adjusting interest rates. Lowering interest rates can encourage people to spend more, which may lead to inflation if the supply does not increase to meet the heightened demand. Demand pull inflation is a common economic phenomenon observed during periods of high demand and limited supply. The Great Recession and the COVID-19 pandemic are two recent examples which such inflation occurred. In India, the CPI and WPI are used to measure inflation, and the RBI plays a crucial role in managing it through monetary policies like adjusting interest rates to stimulate or control the economy. In times when the economy faces inflation, just keeping your funds in cash or a savings account isn't enough, as the value of your money goes down over time. You should think some choices to stay ahead of inflation. Stocks. Even though the price of individual shares can go down, investing in a well-diversified market index fund usually gives better results in the long run. This type of investment has the potential to outperform inflation and help our wealth grow. Bonds. They don't give as much profit as stocks, but bonds are safer. If you don't like taking risks or are close to retirement, you might prefer the steadier returns that come from investing in bonds and bond funds. Inflation index bonds. The RBI introduced these bonds to keep your money safe from inflation. These are special government bonds that give you a fixed interest payment on the original amount invested, which is adjusted according to inflation. This way, you get a protected return regardless of how prices rise. Now, let's talk about gold. Some people think gold is the best investment to protect against inflation. But remember, the price of gold can change a lot and is affected by various factors like global currency movements and supply and demand. Plus, if you hold gold for over a year and sell it, you might have to pay a higher tax compared to stocks and bonds. So make sure you think carefully before choosing gold as your go-to inflation-beating investment. It's important to understand the extra responsibilities and costs that come with owning gold, like storing it safely and dealing with potential taxes when you sell it. Thanks for watching and engaging with us. If you enjoyed this video and found it informative, I would like to receive your support. Please give it a like, share it with your friends and family, and subscribe to our channel.